Imagine your investment grows bigger and bigger. Now imagine selling it means a painful tax bill shows up. That simple problem is where this whole story begins. The rich often hold assets that rise in value over time. Their wealth may explode on paper, even if they never sell anything, and that difference matters a lot. So here's the big question. How do wealthy people enjoy their wealth without constantly triggering taxes? The answer is a strategy called buy, borrow, die. The name sounds dramatic, but the idea is actually simple. First, you buy assets, then you borrow against them, and finally, the tax rules at death can reset the game. These three steps work together like a system. Buy creates growth, borrow creates cash without a sale, and the final step can erase old capital gains for heirs. Before we go deeper, this is an educational explainer, not personal tax advice. Real life is more complicated, but the basic logic is surprisingly easy to understand. Let's start with a regular investor mindset. Most people think if I need cash, I sell something. That sounds normal, but it also creates a taxable event. That's the fork in the road. One person sells and pays tax. Another person borrows and keeps the asset. Same need for cash, very different tax result. An unrealized gain is just an increase in value that hasn't been locked in by a sale. On paper, you got richer, but legally, you may not owe tax yet. Let's say you bought something for $100. Years later, it's worth $500. You gained $400 on paper, but that gain is still unrealized. The moment you sell, that paper gain becomes real. That's when capital gains tax can kick in. Selling turns growth into a tax event. But if you keep holding the asset, no sale happens yet. The value may keep climbing, and the tax bill stays deferred. Now we enter step 1, buy. The wealthy buy assets they believe will grow strongly over time. Think stocks, ETFs, real estate, or private businesses. Stocks and funds are common because they can grow for years. Some may also produce dividends along the way. That creates both wealth and optional income. Real estate is another favorite. It can appreciate over time, may generate rent, and can often be used as collateral. That makes it useful in more than one way. Private businesses also fit the strategy. If a company becomes much more valuable, the owner may become extremely wealthy without selling shares. That means huge paper gains can build quietly. The goal is not fast flipping. The goal is long-term appreciation. The longer the value rises without a sale, the bigger the deferred gain can become. Patience is a huge part of this system. Holding matters. Wealthy investors often let time do the heavy lifting. Some assets even throw off income while they grow. Rent, dividends, or business cash flow can help. That makes the whole machine even stronger. So the buy phase is really about stacking appreciating assets. Build the base first. Without valuable assets, the rest of the strategy barely works. But eventually, even rich people want cash. They may want to spend, invest more, or fund a lifestyle. And this is where most people would sell. Selling feels obvious because it turns assets into money instantly. But selling also wakes up the tax system. That's exactly what this strategy tries to avoid. When you sell an appreciated asset, part of the money may disappear to taxes. So even though you had wealth, you keep less of it. That tax bite is the pain point. Now comes step 2, borrow. Instead of selling the asset, the wealthy use it as collateral for a loan. They get cash, but they still own the asset. The bank looks at the portfolio, property, or business value. If the asset is strong enough, the lender may offer a credit line. That loan creates liquidity without a sale. And here's the key. Loan proceeds are generally not treated as taxable income. So cash arrives, but there may be no capital gains tax triggered. That's why this strategy is so powerful. The person can spend borrowed money today. Meanwhile, the original asset may still keep growing. This is the weird part for beginners. You still have the asset, you also have cash from the loan, so it can feel like you unlocked wealth twice. Of course, borrowing is not free, interest must be paid, but wealthy households may prefer interest costs over a large immediate tax bill. In the stock world, this can look like a securities-backed line of credit. The portfolio stays invested. The investor gets access to money without selling shares. In real estate, it can look like a cash-out refinance. Instead of selling a property, the owner borrows against built-up equity. That creates tax-free liquidity in the short run. Business owners can do something similar too. If their company has value, they may borrow against that value rather than selling ownership. Again, the theme is the same: cash without sale. But let's be clear, debt is still debt. This is not free money. The loan must be managed carefully. If the asset drops in value, the lender may get nervous. A falling portfolio or weak property market can make borrowing much riskier. That can change the math fast. Sometimes lenders demand more collateral or repayment. That's what makes margin calls so dangerous. A strategy built to avoid selling can suddenly force selling.
Interest rates matter too. If rates rise, the cost of borrowing rises with them. A smart strategy can turn ugly if debt gets too expensive. There's also a wealth barrier here. Not everyone can get large, cheap loans against assets. This system works best for people who already have major wealth, strong credit, and bank access. So here's the basic comparison. Selling gives you cash but may trigger tax now. Borrowing gives you cash too, but often delays that tax moment. Yale Budget Lab estimated that under baseline assumptions, borrowing had about a 12 percentage point tax advantage over selling. That helps explain why this strategy keeps getting so much attention. The incentive is real. That's step 2 in plain English. Keep the asset, borrow for liquidity, delay the tax trigger. Now we arrive at the most uncomfortable step in the name, die. This is not about drama, it's about what happens to assets under inheritance rules. When the owner dies, the assets may pass to heirs, and the tax basis of inherited property is often adjusted to fair market value at death. That rule is a huge part of the strategy. Basis is basically the starting value used to measure gain for tax purposes. If basis resets upward, a lot of old gain can disappear. That's called a step up in basis. So if an asset was bought low and grew massively, the old low basis may be replaced by the higher market value at death. In simple terms, the gain during the original owner's life can be wiped away for heirs. That is the magic of the final step. Now the heirs receive the asset at the stepped-up value. If they sell soon after inheriting it, there may be little or no capital gain to tax. The old lifetime appreciation is basically gone from the tax calculation. At that point, heirs can use some of the proceeds to pay off the loan. The debt gets cleaned up, and the family may still keep the remaining wealth. That's why the strategy is so powerful for generational wealth. The original owner enjoyed liquidity without a sale, then the heirs may receive a much cleaner tax position. And if the heirs keep the assets instead of selling everything, the cycle can continue. They can buy, borrow, and eventually pass assets again. That's how fortunes can last across generations. Now you can see the full loop. Appreciation builds up, borrowing funds life without a sale, and inheritance rules can erase the old gain. The main prize here is avoiding capital gains taxes that would usually happen on a sale. No sale means no realization during life. Then the step-up can finish the job later.
Estate taxes are a separate issue, and they depend on estate size and the law at the time. So buy, borrow, die is not the whole estate plan, but it can work alongside estate planning in a major way. Critics say this helps wealth pile up at the top. Families with large assets can hold, borrow, and pass wealth with less tax friction. That's one reason the strategy is so controversial. The phrase itself comes from USC law professor Ed McCaffery. He created it to explain this pattern in simple language, and honestly, the phrase stuck because it describes the system perfectly. One of the biggest surprises is this: the strategy is generally described as illegal. It's not some secret magic trick only invented by shady accountants. It's built around how the rules already work. But no, this does not mean everyone can do it easily. The strategy works best when you already own valuable, appreciating assets. It takes wealth to really scale it. Could a regular homeowner use a tiny version of the idea? Maybe through home equity borrowing, but the risks are much more personal when the asset is your actual home. That's the part social media often skips. This strategy is powerful, but it also adds leverage and stress. If the debt gets out of control, the damage can be serious. That leads to the fairness question. Is this just smart planning, or does it prove the tax system treats wealth differently from work? Because of that debate, researchers have suggested reforms. One idea is to treat certain borrowing like a taxable sale. In other words, borrowing would trigger tax the way selling does. Another idea is a withholding tax on borrowing. That would force some tax to be prepaid when the loan is taken. Later, the amount could be adjusted against actual gains. A third idea is an annual tax on certain loan balances. That approach is simpler in some ways, but it may also hit people borrowing for reasons unrelated to tax avoidance. Yale Budget Lab estimated these three reform options could raise about $102 billion, $147 billion, and $130 billion over 10 years. So this is not just theory. Policymakers are actively modeling it. At the same time, Yale also notes a caveat. Borrowing is only a small share of income even for the ultra-wealthy in the aggregate, so fixing this one strategy alone would not solve the entire wealth tax debate. So what should normal people actually learn from this? First, wealth usually grows through owning appreciating assets. That lesson matters at every income level. Second, selling too often can create friction and taxes. Long-term thinking usually wins. Even if you never use this exact strategy, patience is powerful. Third, borrowing should be treated with respect. Sometimes interest on investment borrowing may be deductible, but only under specific IRS limits. Debt can help, but careless debt can hurt. And finally, tax planning and estate planning are deeply connected. What you own is important, but how you hold it, borrow against it, and pass it on matters too. Let's recap the whole thing in one breath. Buy assets that grow, borrow against them instead of selling, then the step up in basis can erase old gains when assets pass to heirs. Whether you see this as genius or unfair, it changes how you look at money. The rich do not always live off income the way workers do. Often, they live off assets and loans. And that is buy, borrow, die in simple English. If you want more stickman videos on taxes, investing, and wealth, hit subscribe and drop your next topic in the comments. I'll see you in the next one.